There is no new car in America under $20,000. Not one. For the first time since mass production began, the cheapest new vehicle on any lot in the country starts above $22,000, and every month it gets worse. If your car payment is eating into your paycheck right now, you're not imagining it. The average monthly payment on a new vehicle just hit $770, a record, and auto loan debt in this country has crossed $1.68 trillion, more than every outstanding federal student loan combined. Subprime borrowers are missing payments at a rate this country has not seen in 32 years, worse than the 2008 crash. None of that happened by accident. A handful of executives in Detroit made a decision 5 years ago that they never had to explain to you, and you have been paying for it every month since. For 100 years, a new car in the driveway meant something. Fresh plates were proof you had made it, and Detroit built an entire economy selling that feeling to every generation after the last one. That feeling is dead now, and it did not die on its own. It was killed on purpose, in a boardroom, by people who did the math and decided you were worth less to them as a customer than you used to be. Here is the math they did. Sell half as many cars for twice the profit. Cut the cheap models. Let the expensive ones carry the business. It sounds like a strategy memo. It is actually the reason you cannot find a basic car for under $20,000 anywhere in America, and the reason your neighbor is driving a car older than their kid. That decision has a birthday. It happened in 2021, and once you see how it happened, you will never look at a sticker price the same way again. In 2021, a global shortage of computer chips brought car production to a stop. Factories sat half empty. Dealer lots emptied in weeks. For the first time in decades, automakers could not build enough cars to meet demand, and buyers were bidding against each other for whatever came off the line. Executives noticed something happening in real time. With fewer cars to sell, nobody had to compete on price. Sticker prices went up. Discounts disappeared. Profit per vehicle hit numbers the industry had never touched, even while total sales fell. The chip shortage eventually eased. The pricing behavior did not. Automakers had tasted a kind of profit built on scarcity instead of volume, and once you taste that, you do not walk away from it voluntarily. Here is what that bet actually cost at the bottom of the market. In 2017, automakers in this country built 36 models priced at $25,000 or less. Today, there are 4. The Nissan Versa, the last car under $20,000 in America, went out of production this year. Before that, it was the Mitsubishi Mirage, killed in 2024 at $16,695. Kia retired the Forte and replaced it with the prettier K4. The cheapest new car left in the country is the Hyundai Venue, and it starts around $22,650 once you add the fees. Every one of those discontinued cars was built overseas, where labour kept the price low. When a 25% tariff hit imported cars and parts, the thin margin on budget models disappeared, and automakers walked away from the entry point instead of protecting it. They did not stop making money, they stopped making a way in. With the cheap models gone, here is where American buyers landed. The average new car loan now runs $43,925, and the typical monthly payment sits at a record $770. To keep that number from looking impossible, lenders stretched loan terms out to 72, 84, even 96 months. A car loan now lasts as long as some mortgages did a generation ago. Run the real math on what that costs. Finance a $30,000 car over 6 years instead of 4, and you pay roughly $14,000 more in interest alone, enough to cover a year of childcare or 6 months of groceries for a family of 4. Stretch a loan out that far, and the car depreciates faster than the balance shrinks. Nearly a third of trade-ins toward a new car purchase right now carry negative equity, owing an average of over $7,000 more than the car is worth, and that debt gets rolled straight into the next loan. This is not a story about buyers making bad choices. Research from the Federal Reserve points to high vehicle prices, not high interest rates, as the actual driver of the pain. Nobody wants an 84-month loan. People take one because the sticker price on a basic car leaves them no other option that fits their paycheck. You would think, after locking in a payment that size, the industry would leave a buyer alone. It did not. The car was sold, the loan was signed, and somehow automakers found a way to charge the same customer twice. In 2022, BMW rolled out a subscription for heated seats already built into the car. The wiring was there, the heating element was there. BMW just would not switch it on unless you paid $18 a month. Drivers found it insulting enough that BMW killed the program by late 2023, with an executive later admitting that heated seats were probably not the place to start. Toyota tried something similar, charging $8 a month for remote start through a key fob that buyers assumed they already owned. Some Mazda owners got frustrated enough with paywalled features that they hacked their own cars to unlock functions they had already paid for on the lot. Lawmakers stepped in before the industry could. New York now bans automakers from charging subscription fees for hardware already built into a car that works without ongoing software support. New Jersey and Massachusetts have similar bills moving. Even inside the industry, the mood shifted. Volvo's chief commercial officer said the quiet part out loud, that someone spending $80,000 on a car should not be asked for another $5 a month to use heated seats, especially when cheaper cars include the same feature for free. The subscription math was never complicated. Analysts expect connected service revenue industry-wide to grow from around $6 billion in 2024 to $15 billion by 2030. Automakers found a revenue stream sitting inside a car buyers had already paid for once and tried to sell it to them twice. Regulators shut the front door on that trick fast, so the industry found a back door instead. It was standing on the showroom floor the whole time, and it did not need a software update to operate. It just needed a customer with nowhere else to go. During the scarcity years, dealers layered so-called market adjustment fees on top of the sticker price, sometimes tacking on thousands of dollars simply because a car was hard to find. Buyers who used to negotiate below MSRP were suddenly paying above it, sometimes far above it, just to drive off the lot at all. That behavior left a mark that has not faded. A car purchase used to run on one basic assumption, that the number on the window was a starting point for negotiation, not a floor the dealer could push higher depending on their mood that week. Once that assumption broke, so did the relationship between buyer and seller. Brand loyalty in this business has always depended on people feeling like they got a fair deal, even a good one. Dealers spent the scarcity years training an entire generation of car shoppers to expect the opposite, and now that inventory has normalized, trust is not snapping back nearly as fast as pricing power did. Buyers remember getting extorted for a Tucson or a Bronco in 2022, and that memory follows them into every purchase after it. It shows up in the reviews before a customer walks in the door. It shows up in the posture the moment they sit down at the desk. The industry spent years teaching its own customers not to trust it. And customers learned the lesson better than anyone in that boardroom expected. They stopped walking back into the showroom at all. So what did all that price gouging, loan stretching, and subscription nonsense actually produce? A quiet, widespread rebellion. Americans are keeping their cars longer than at any point in recorded history. The average vehicle on US roads is now 12.6 years old, a record, up from 9.6 years back in 2002. This is not people settling for less. Auto parts retailers like AutoZone and O'Reilly have seen revenue climb nearly 40% since 2019, driven directly by drivers choosing repair over replacement. Americans now spend close to $1,000 a year keeping an existing car running, and the aftermarket repair window that used to mean 6 to 11 years of vehicle age keeps stretching wider to match the aging fleet. There is a real shift buried inside those numbers. A new license plate used to be a status symbol, proof you had arrived somewhere financially. Now, keeping a well-maintained older car running is becoming its own kind of pride. People are learning to do their own oil changes again. They are finding a mechanic they trust instead of a finance manager they do not. The passenger car fleet in America has actually dropped below 100 million vehicles for the first time since the early 1970s, even as total vehicles on the road keep climbing. People are not buying less transportation. They are refusing to buy it new and refusing to buy it on the industry's terms. If you have kept a car running past 100,000 miles out of pure stubbornness, tell me the make and model in the comments. I want to know what is still out there. Electric vehicles were supposed to be the industry's reset button, a fresh start with buyers tired of the old pricing games. Instead, they walk straight into the same trap. New EV inventory has ballooned to 130 days of supply as of early 2026, 46% higher than gas-powered cars sitting on the same lots. New EV sales fell 28% in the first quarter of 2026 compared to the year before. The federal tax credit that once knocked $7,500 off the price disappeared entirely at the end of September 2025. Without it, the average EV transaction price sits around $55,300, uncomfortably close to what buyers already resented paying for a gas-powered car. Here is the twist nobody in Detroit or Fremont saw coming. Used EVs are thriving. Sales of used electric vehicles jumped 12% in the same quarter. New EV sales collapsed, turning over on dealer lots almost as fast as used gas cars. Buyers want the technology. They just refuse to pay the first owner's premium for it anymore. Technology was never the problem. Range anxiety, charging networks, none of it mattered as much as the simplest issue on the lot. The price tag on a new EV carried the same bloated math as everything else, and buyers who had already been burned by subscription fees and market adjustments were not about to trust a shinier version of the same pitch. The industry's supposed second chance cracked the same way the first one did, right as the financial consequences of every decision in this story finally landed on the balance sheet, in public, in front of shareholders. Look at what happened to Stellantis, the parent company of Jeep, Ram and Chrysler. In February 2026, the company announced €22.2 billion in charges tied to a strategic reset and cancelled EV programs. It suspended its dividend entirely. The stock dropped hard in a single trading session, one of its worst days on record, and credit agencies moved to downgrade the company shortly after. This is the trap the whole industry built for itself. After years of inflated pricing, automakers cannot simply lower prices to win customers back. The moment they try, Wall Street reads it as an admission that demand has collapsed, and the stock gets punished immediately. Stellantis rolled out a €60 billion turnaround plan in May 2026, and shares dropped again on the news because investors wanted something more aggressive than what they got. Ford has dealt with its own supply disruptions and sales declines. Industry-wide year-to-date sales in 2026 remain down roughly 5% from the year before, even after a slight bump in May driven mostly by fleet and rental deliveries rather than everyday buyers walking into a showroom. Automakers are now stuck between two bad outcomes: keep prices high and watch inventory rot on the lot while buyers walk away entirely, or cut prices and watch investors punish the stock for confirming what everyone already suspected, that the pricing model was never built to last. There is no clean exit from a trap you build with your own hands. The industry is finding that out in real time, one earnings call at a time. Every piece of this story traces back to one decision made in 2021. Automakers looked at a supply shortage and saw an opportunity instead of a temporary problem. They chose margin over volume, scarcity over access, and short-term profit over relationships that took 100 years to build. The bill for that decision has come due. Auto debt sits at a record $1.68 trillion, more than the entire federal student loan balance. Delinquencies are worse than in 2008. The cheapest new car in America costs more than $22,000, an amount that would have bought a mid-size sedan a decade ago. Subscription fees angered buyers who felt charged twice for the same hardware. Dealership markups broke the trust, which has not returned. Used cars are outliving their owners' patience for new ones. Even electric vehicles, the industry's supposed second act, are sitting unsold while used EVs fly off the lot instead. Here is the part the industry still has not said out loud. It is no longer in the business of selling transportation. It is in the business of selling debt, packaged into 84-month terms and dressed up as a monthly payment small enough not to scare anyone at the signing table. And debt markets built on buyers who cannot actually afford the product do not correct quietly. They break. That driveway with the fresh set of plates still exists in this country. It just does not belong to the same buyer anymore. The plates on it now might belong to a car that's already 12 years old, and for the first time in 100 years, that is not a failure. That is the only rational move left. If this changed how you look at your own next car purchase, tell me what hit hardest in the comments. And if you want the next investigation delivered straight to you, hit subscribe before you go.